Welcome to the Deep Dive. We're here to take the strategic documents shaping tomorrow's economy and, well, translate them into real, actionable insight for you. Today, we are immersing ourselves in what is probably the single biggest mandate facing pharmaceutical companies right now. We're talking about the transformation into Pharma 4.0. And for this, our sources are incredibly practical. We're digging into excerpts from the Digital Pharma Flow, the 2026 Playbook by Dr. Jayant Joshi and Umesh Naik. So we're not talking about high-level theory here. This is a blueprint. It gets right down to the financial frameworks and the benchmarks you need to actually pull off this massive transformation. And our mission today is, frankly, zero tolerance for buzzwords. I want to cut straight to the data. What are the investment numbers? What are the metrics you need right now to prove this is all worth it?
And the playbook, it establishes the urgency right away. This has moved completely out of the nice-to-have column. The authors are really clear. They call it a non-negotiable operational mandate if you want to be competitive by 2026.
A non-negotiable mandate? And why? What's the prize?
It's colossal. The potential value unlocked is it's massive. They suggest digital initiatives could create over $100 billion in annual value for the industry.
Oh.
So for you, the real challenge is navigating that, that complexity and getting from a pilot project to real value.
Okay, 100 billion. But let's start with a dose of reality, because that journey is littered with failures. Before we talk success, we have to talk risk. And the source material drops the statistic that it should genuinely stop any executive in their tracks. Over 70% of digital projects in this space fail to meet their expected ROI.
70%.
It's an enormous number.
That's just a huge amount of capital being poured into a digital void.
And that failure rate, it isn't a technology problem. The playbook is very clear on this. It's a strategy and a culture problem. And it pinpoints three sort of core reasons for this. The first is poor use case selection.
Meaning they buy the tool first and then go looking for a problem to solve. Exactly. That's a perfect way to put it. Companies invest in sophisticated AI or machine learning without first targeting a specific high-value business problem.
Right.
It's technology chasing some vague potential instead of answering a really sharp question like, how do we cut our batch rejection rate by 5%?
That makes a lot of sense. So the playbook also lists fragmented data foundations as a cause. Why isn't that number one? Doesn't bad data make everything else impossible?
It should. But what often happens is the company buys the tech, thinking the tech itself is somehow going to magically fix the data problem. It won't.
Yeah.
Which brings us to the second cause. Weak change management. This is the quiet killer of great projects. Organizations just consistently underestimate the cultural shift required. You can deploy the best system in the world, but if the operators on the floor go back to their old paper methods, the tech delivers zero ROI.
So people and process are just as important as the software purchase.
At least as important. And then you hit that technical barrier you mentioned, the third cause, fragmented data foundations.
The engine stalls.
The engine stalls.
Right.
Data is the engine of Pharma 4.0. And in practice, this means you have data trapped in paper records or in all these different siloed systems, your LIMS, your MES, your ERP, that just can't talk to each other. And without that clean, integrated data, your advanced AI is just a very, very expensive spreadsheet.
So if 70% of these one-off projects are failing, the playbook's solution seems clear. You have to stop thinking in terms of isolated pilots.
Absolutely. You have to adopt a balanced portfolio strategy. It's about balancing your risk and your reward.
Okay, what does that look like?
Well, you combine a few high-risk, high-reward big bets. These are for your huge transformational changes, like a global predictive maintenance platform. But, and this is crucial, you balance those big bets with multiple smaller, lower-risk, fast payback use cases.
Okay, give me an example. What's a fast payback use case in pharma?
It could be something as focused as deploying an OEE dashboard on one single critical packaging line, or maybe digitizing the deviations workflow in just one quality lab.
So you get some quick wins on the board.
You get quick wins, you build knowledge, you create champions for the program, and most importantly, you generate measurable ROI that you can then use to fund those bigger, riskier bets. That's how you keep the momentum going.
But all of this, it still needs capital. Let's get into the price tag. What does a successful program actually look like financially?
Okay, let's set the expectation right away. A successful, fully realized program is targeting a very real 15 to 25% reduction in total operating costs.
15 to 25%, that's not trivial.
Not at all. And this comes from things like higher process yields, less scrap, and real measurable gains in labor productivity. The key is that these programs are designed to deliver a documented payback within about 18 to 36 months.
Is that target realistic for a mid-cap pharma company, or is that mostly for the mega majors?
The playbook suggests it applies across the board. Because, mid-cap pharma often has more of that low-hanging fruit, older systems, less efficient processes. So that initial 15% can actually be achievable faster with those fast payback projects. The real challenge is the upfront cash.
Okay, so what does that peak capital allocation look like? If you're planning your 2026 budget, what's the number you need to be ready for? Joshi and Ike say companies should plan to allocate 15 to 20% of their annual manufacturing or operations budget to these initiatives at peak. That is a significant ask.
It is. And the investment, it doesn't scale in a straight line, which is the real budgeting headache. But the playbook is super helpful here. It breaks down the total cost of ownership, the TCO, into 3 very distinct stages.
Okay, let's walk through them. Stage 1.
Stage 1, the single-site pilot. This is all about proving value. So the CapEx, the initial spend, is pretty constrained. We're talking between $500,000 and $2 million USD.
And the total cost over 3 years.
The 3-year TCO for that pilot sits between $1 and $3 million.
Right.
And that covers your core software, some basic integration, sensors, and, of course, all the validation you need for GxP compliance.
That feels manageable, but then the cost and the complexity, they just jump, right, when we get to stage 2, the multi-site rollout.
That's where the nonlinear curve really hits you. Now you're building the core platform across, say, 3 to 5 key sites.
And the numbers.
For this multi-site rollout, you're looking at CapEx between $5 and $15 million, usually spent over 18 to 24 months. The 3-year TCO for this stage is benchmarked much higher, at $8 to $20 million.
So what's the one cost bucket in stage 2 that companies always underestimate? Is it the software licenses? The validation?
Integration. It's almost always integration and data platform costs. The license fees are predictable, but connecting 3 or 5 legacy systems, an ancient LIMS system here, a custom MES there to a modern cloud platform, that's where the time and the consultant fees just explode. That's what drives that massive TCO jump.
And then finally, you're ready for stage 3, the enterprise program, global scale.
This is global scale, maybe 10 or more sites, full automation, predictive analytics baked into how you operate.
And the financial scale here is?
It's massive, and it's variable. We're talking CapEx between $15 and $50 million, sometimes a lot more. The 3-year TCO is benchmarked at $20 to $60 million plus. And the playbook specifically notes that the high end of that range, the $50 to $60 million, that's common when you decide to finally rip and replace those huge old legacy systems like an ancient ERP across multiple regions at once.
Beyond just the raw numbers, the playbook highlights this really critical financial trend for 2026 budgeting, and it changes how a CFO has to think about this. It's the shift to as-a-service models.
Yes. Historically, the classic model was, 60 to 75% CapEx?
Yeah.
A huge upfront payment for licenses and hardware. Massive cash flow shock.
And that's becoming an old way of doing things.
It is. With subscription-heavy SaaS models, the split between CapEx and OpEx is getting much closer to 50-50.
Which is more appealing to the board, I imagine. Less sticker shock.
Exactly. It reduces that peak upfront investment. But you're trading that for something else. A persistent, higher annual OpEx. So the finance team needs to be ready for that. The immediate cash flow ease turns into a predictable annual headache you have to budget for.
So the whole strategic discussion shifts from, can we afford this huge project, to can we absorb this higher operating expense for the next 5 years? It's a different conversation. Okay, so we've established the cost, the risk, and the 70% failure rate. Now we have to talk about the ultimate challenge, proving the $30 million commitment was worth it. The playbook calls this the critical gap.
The critical gap, yeah. It's that fundamental disconnect between the metrics that operations uses, things like efficiency, quality, and the language the C-suite speaks, which is demonstrable ROI, margin growth, shareholder value. If your ops team is celebrating a 1% efficiency gain, how do you translate that into something the CFO actually cares about?
It's a language barrier. So the solution in the framework is a unified set of KPIs that can bridge that gap.
That's the idea. The playbook is built around what it calls the 3 pillars of performance to measure that ROI.
Okay, pillar 1.
Pillar 1 is cost optimization. This is all about revealing hard savings and quantifying the financial drains that are already happening. You're making the current inefficiency undeniable.
And the most powerful metric here, often hidden, is the cost of poor quality, or COPQ.
Yes. This is so powerful because it takes quality issues out of the operations problem bucket and puts a real dollar sign next to them. It tracks your deviations, your rework, your recalls, all as a percentage of revenue.
So if you reduce rework by 10%, you can point directly to the cash you saved.
That's a hard number. And under this pillar, you also have inventory carrying cost. Think write-offs, expiry, storage, even stockouts. Digital visibility just shrinks all those hidden costs.
All right, on to pillar 2.
Pillar 2, productivity and throughput. This is about how efficiently you're using your most expensive assets. And the gold standard metric here is overall equipment effectiveness, or OEE.
OEE is so critical, and the playbook emphasizes you have to break it down. It's not just one number.
Exactly. You have to look at its 3 parts: availability, performance, and quality. Is the machine down? Is it running too slow? Or is it making scrap? That's what turns OEE from just a metric into a real action plan.
Right.
And a close partner to that is the right first-time rate. Basically, what percentage of your batches pass quality on the first try. A higher rate means less intervention, faster cycle times, and faster time to market.
And finally, pillar 3, which is supply chain excellence. This is about service levels and resilience.
And the key customer metric here, tied directly to digital visibility, is on time, in full, or OTIF.
Can you deliver the right product, right quantity, right time?
That's the ultimate question for the whole business. And digital transformation is what makes the visibility for that possible.
And for pharma specifically, with cold chains, the playbook points to the condition excursion rate.
Yes, and the value isn't just measuring a temperature deviation. It's about the financial calculation. You don't just say, we had an excursion. You say, we avoided X million dollars in product loss because our real-time monitoring caught the problem.
That's a direct, measurable financial gain from the tech investment.
It is.
And that really brings us to the core principle that ties all of this together. The playbook says you must make the link to ROI explicit.
That is the #1 rule. Every KPI improvement has to be linked to a baseline, a target, and a financial value. The conversation has to change from OE is up 1% to that 1% OEE gain delivered an additional X thousand pounds in profit this quarter. That's the only language that matters in the boardroom.
Okay, so let's pull this all together. We've covered the massive investment needed. You need to be ready to allocate 15 to 20% of your ops budget at its peak. We've mapped out the 3 stages of the rollout, from that $3 million pilot all the way up to the $60+ million enterprise program, and we've laid out that 3-pillar framework for actually measuring the return on that investment.
And the core lesson for you, the listener, is that capturing your share of that $100 billion prize, well, it requires a long-term strategic view. This has to be a 3 to 5 year journey. You have to move beyond those isolated projects to create real enterprise-level value.
Because the alternative is ending up in that 70% failure group.
That's the alternative.
But here's where it gets really interesting for executives. While you have all these dozens of metrics, the playbook boils it down to a unified framework where senior leaders only need 5 KPIs to track the strategic outcomes.
That's right. That dashboard of 5 is specifically designed to bridge that critical gap we talked about. It combines efficiency, quality, cost, and service. And they are OEE, OTIF, inventory turns, cost per batch, and the cost of poor quality, COPQ.
And those 5 metrics work because they capture the whole cycle, right? OEE for efficiency, COPQ for quality costs, inventory turns for capital efficiency, and OTIF for the customer. If those 5 are heading in the right direction, you know you're winning. So what does this all mean for you right now? If success by 2026 means avoiding that 70% failure rate, you have to decide where to focus. If you could only tackle one of those structural barriers this quarter, is it fixing your fragmented data foundations? Is it improving your weak change management and getting people on board? Or is it being more rigorous about your use case selection?
Choosing which of those levers to pull first is what will determine if your multi-million-dollar investment becomes a success story or, just another statistic. That strategic choice is your immediate next step.